Have you ever noticed that in global trade, the loudest countries are not always the ones winning? Right now, while the United States makes headlines for tariffs, trade wars, and political standoffs, another country is quietly racking up wins. Let me tell you something you probably didn't know. In 2024, Canada's main Pacific port shattered all-time records, handling 158 million metric tons of cargo, and almost nobody outside the shipping world talked about it. This isn't just about one port. Across 5 critical trade corridors, Canada is building a reputation for reliability, the one commodity every company wants in 2025. And if you think this is just a lucky streak, wait until you see the numbers and the strategy behind it. If you're shipping goods from Asia to North America, the Pacific Coast is your front door. For decades, that meant Los Angeles, Long Beach, or Seattle. But here's the problem. Those ports are big, they're busy, and sometimes they're unpredictable. Labor strikes, backlogs, and congestion can cost companies millions in delays. Now imagine this. You're a South Korean electronics giant. You can send your shipment to California and risk sitting offshore for days. Or you can send it to Vancouver and have it on a train to Chicago within 48 hours. In 2024, more companies chose option 2 than ever before. The Port of Vancouver handled 158 million metric tons of cargo, up 5% year over year. The bulk sector hit 117.9 million tons. Liquid bulk exports skyrocketed 203% to 17.1 million tons, and auto imports climbed to 470,000 vehicles. Container traffic? Up 11%, hitting 3.47 million TEUs. There's no accident here. Canada has poured billions into rail infrastructure linking Vancouver and Prince Rupert to the industrial heartland. The result? Trains that move goods faster than U.S. West Coast routes, with fewer labor disruptions. That's why Prince Rupert, a smaller but strategically placed port, has been quietly expanding, targeting shippers from Japan and China who value time as much as cost. So the Pacific Gateway is winning. But what about the other side of the country? Well, that's where the next surprise comes in. Let's pretend you are in the middle of the storm and you're a shipping company in Europe. Your options for reaching North America are the massive crowded ports of New York and New Jersey, or a smaller, high-tech, eco-friendly port in Halifax, Nova Scotia, that can turn your ship around faster and cleaner. Which would you pick? The Port of Halifax has been making that decision easier by going green. Backed by a $22.5 million federal investment, Halifax is building green shipping corridors, routes where vessels use low-emission fuels and advanced tech to cut their carbon footprint. With the International Maritime Organization tightening environmental rules, this isn't just nice to have, it's becoming a requirement. Halifax isn't the only player. Ports in St. John, New Brunswick, and St. John's, Newfoundland are also modernizing, offering competitive docking fees and faster customs clearance than many U.S. East Coast competitors. And with Europe exporting more EVs, batteries, and specialized machinery to North America, Halifax's green credentials are becoming a competitive weapon. If you think eco-friendly shipping is just marketing fluff, here's a stat for you. The global green shipping market is projected to hit $30 billion by 2030. Halifax is positioning itself to grab a chunk of that. But while the Atlantic story is impressive, there's another frontier that feels straight out of a geopolitical thriller, one that could rewrite the map of global shipping altogether. For centuries, explorers dreamed of the Northwest Passage, a shipping shortcut through the Arctic from the Atlantic to the Pacific. The problem? Ice. Lots of it. But climate change is opening sea lanes that were once frozen year-round, and Canada is sitting on the doorstep of this new frontier. The Port of Churchill in Hudson Bay is Canada's northernmost deepwater port, connected to the rail network. It's perfectly positioned for Arctic shipping, bypassing the Panama and Suez Canals and shaving up to 2 weeks off Asia-Europe routes. Canada isn't just waiting for the ice to melt, it's preparing for the rush. Through partnerships like the Ice Pact with Finland and the US, Canada is investing in icebreaker technology, Arctic navigation systems, and safety regulations. And here's why that matters. The Arctic is believed to hold 13% of the world's undiscovered oil, 30% of undiscovered natural gas, and critical shipping lanes that could become year-round by mid-century. Whoever controls safe passage controls serious leverage in global trade. But Arctic shipping is still in its infancy. The real immediate leverage for Canada comes from something far more tangible: the commodities every country needs right now: food and clean energy. When it comes to feeding the world, Canada is a heavyweight. It's the fifth largest exporter of agricultural commodities, shipping wheat, canola, pork, and seafood to more than 200 countries. In 2023, agri-food exports hit $92.8 billion, a record high. Reliability is Canada's brand. No major export bans, no sudden price controls. For nations that remember the chaos when other suppliers restricted grain exports, that matters. In January 2025, Canada signed a new free trade deal with Ecuador, opening more agricultural markets in Latin America. And energy? This is where Canada's strategy really shines. Sure, it still produces oil and gas, but it's also one of the world's largest producers of hydroelectricity, supplying 60% of its domestic power from water. That clean grid makes Canadian exports even more attractive to countries trying to lower their carbon footprint. The Cedar LNG project in British Columbia is a prime example, a $3 billion indigenous-led venture that will export 3 million tons of liquefied natural gas per year, powered entirely by clean hydroelectricity. That's a selling point that fossil fuel competitors simply can't match. But food and clean energy are only part of the puzzle. The biggest shift in the global economy right now revolves around the race to build and control the supply chains for electric vehicles. And Canada is sitting in the driver's seat. Without critical minerals like lithium, nickel, cobalt, and graphite, there is no EV revolution. And for decades, China has dominated these supply chains, controlling around 60% of mining and 90% of processing in rare earths. But the world is waking up to the risks of over-reliance. Enter Canada. In 2024, Bloomberg NEF ranked Canada as the #1 country in the world for EV battery supply chain potential, overtaking China. Why? 3 things: massive mineral reserves, a clean energy grid, and a stable political system with high environmental and labor standards. This isn't just theory. The investments are already in motion. Since 2020, more than $46 billion in private capital has poured into Canada's EV supply chain, alongside an estimated $52.5 billion in federal and provincial incentives. Honda announced a $15 billion Canadian investment in Ontario for an EV production hub that will build 240,000 electric vehicles per year and produced 36 gigawatt-hours of batteries. Volkswagen, Stellantis, and Sweden's Northvolt are building massive gigafactories. In Saskatchewan, a $100 million rare earth processing facility will supply materials for 500,000 EVs annually, cutting dependence on China. And in Ontario, the U.S. military is helping fund a cobalt refinery that will be the only one of its kind in North America, with 80% of its output already contracted to LG Energy Solution for the next 5 years. Canada isn't just mining, it's building the entire EV ecosystem, from mine to battery to finished car, all within a reliable low-carbon jurisdiction. So what's really happening here? While the U.S. has been flexing its economic muscle through tariffs and trade pressure, Canada has been quietly doing something else: building trust. It's investing in infrastructure, going green where it counts, locking in long-term supply contracts, and creating a business environment where companies can plan decades ahead without worrying about sudden policy shifts. This isn't about replacing the United States. It's about creating an alternative model, one that prizes stability over spectacle and long-term relationships over short-term wins. With the mandated USMCA trade agreement review in 2026, the timing couldn't be more critical. If global companies see Canada as the safer, cleaner, and more predictable gateway to North America, there's a competitive advantage that's hard to take back. Is Canada's rise a permanent reshaping of global trade, or just a temporary gap while the US focuses elsewhere? The next few years will decide whether this quiet revolution cements Canada's place at the top, or fades into just another what-could-have-been story in the history of global commerce. If you want to see how this plays out, hit that like button, subscribe, and stick around, because the next trade war might not be about oil or steel. It could be about who controls the world's supply chains.